Today, Governor Lowe and the Reserve Board met and they've kept the cash rate on hold at 1.5% for April. Now, a lot of commentary in the marketplace over the last month around property. I want to get to that in a minute. Let's just quickly wrap up what's happening, in terms of the world market and mainly the US I want to talk about. We did see the cash rate move up in the US. So Janet Yellen and her team have put the cash rate up to 1%, and we expect to see maybe one, possibly two more movements as their economy starts to gain more and more traction. Really low unemployment over there, so possibly a reasonable story. We've obviously got to see what President Trump is going to do in regards to his tax policies and his economic infrastructure plans. Once we start to see those moving, the US economy is looking good. Their equity markets have been unbelievably strong. So that's been interesting to watch. And I think the broader global economy is looking reasonably well placed. Oil prices, iron ore prices sitting high, that type of thing gives a little bit of confidence in regards to world trade and those type of things. So we move from the world markets. Let's focus in on the Australian market and namely property. I'm going to spend a fair bit of time now just sort of trying to talk to you about what's happening in the property market. Now, we did see about sort of in August 2015, we saw APRA intervene into the marketplace by putting some speed limits in place for how quickly investor loan books can grow. So they said to the banks, you can't grow your loan book by more than 10% per annum. Now that obviously meant that the banks had one hand tied behind their back to do business in that space. Now why were they doing that? Well, effectively, I've mentioned this before, the RBA needed to knock on their door and work out ways in which they could slow down the number of investors getting into the property market. We investors have been very good in terms of picking the right type of investment to invest in terms of residential bricks and mortar, but there is definitely an elevated level of investor activity, namely in Sydney and in also Melbourne. So when you've got that level of economic activity and buying interest in property, we start to push prices too high. So, the RBA completely understand the consequences if we do see a property market collapse. The flow-on effects of that are right throughout the economy, and we only need to look at the GFC, and what was the catalyst for the GFC was the US property market getting too ahead of itself when we saw, interest rates very low and basically, very easy lending going out into the marketplace. So APRA is the lever that the RBA are using to try and slow down the amount of debt that's going into the marketplace for investors. So we've got owner-occupiers with their fear of missing out because property prices are going up really high. And then you've got the investor market also coming in there as well. So that's why we're seeing these record growth rates in regards to property prices. Now, they're not at the very highest levels they've ever been at, but in terms of this growth period is almost in 5 years of positive price growth in both the Sydney and also the Melbourne markets. And that is, quite frankly, unsustainable. So they're trying to slow down that appetite. So we expect to see APRA further intervening in terms of some interventions around what they're going to do. So I suspect that speed limit at 10% will probably be moved back to maybe 7.5%, possibly even 5%. That's one way they can do it. The second way they can do it is to basically, there's an assessment rate that sits above the retail rate that you and I pay as borrowers. Now that assessment rate is usually 2.5% higher than the price we're paying. Why do they do that? Well, basically the banks want to make sure you can repay the loan if interest rates go up. So that's why they do it. Now, when you set that assessment rate higher, it actually impacts the amount of money you can borrow. So if you can't borrow that much money, you can only borrow that much money, there may not be an appetite for investors to get into the market. So we expect they may bring in some type of higher assessment rate for investors as well. Now, that is also correlating to what the banks have been up to over the last month. And I said this earlier in previous videos that I expected the banks to start lifting rates outside of what the Reserve Bank was doing in regards to monetary policy. And we've seen that this month again. We've seen owner-occupiers have small increases in their retail rates that they're paying, but we've seen investor loans absolutely be hit with a full rate rise of around 25-30 basis points. Now, if you're also running interest-only loans, we've also seen the banks put more pressure on those people who run interest-only loans. Now, as a property investor, that disappoints me. It disappoints me also for all the clients that we look after, because the reality is we're big advocates of interest-only lending because we want to be in control of the money. We don't want the banks to be in control of the money, and we use offsets to be able to balance that out. So it's disappointing that, again, we're basically tarred with the same brush as the 5% or 10% of risky borrowers in there, that good, reliable borrowers have to pay a premium because we're basically, setting regulation for that lowest common denominator. So that's frustrating for me, but I can broadly understand why we're seeing these macro-prudential changes, because the economy is reliant so much on what happens in the household. We are the consumers that spend, that generate that GDP. So if we do see a continued growth rate that's unsustainable, there will be a correction, and when that correction comes, it could be recessionary in nature, because ultimately, if the property prices start to fall considerably, everyone will stop, everyone will panic, and there'll be a flow-on effect and a contagion effect in our domestic marketplace. So on one hand, I understand what they're trying to do, and I understand the levers that they're trying to do, because when they do that for just property, they're not affecting business borrowings, and so that business investment, which I always talk about, needs to still be in place. So it's a difficult balancing act that the Reserve Bank has to do, and they're obviously bringing in the likes of APRA and ASIC in regards to responsible lending and what's happening out in that retail land around borrowings and home loans. So it's really important to understand that. So it's going to be an interesting time. It's going to be harder to get finance, and we're going to see hopefully that marketplace rebalance itself to a more sustainable level, where we get 70% owner-occupier and 30% investor. Right now in some markets we're seeing 50, 60% investor, and that is unsustainable, when we're seeing other markets like, say, as an example, Perth, where property prices are off at least 25% in most areas. And so it's really a strong challenge around, there's so much lack of supply, but the demand, as supply is coming on, that's being met by the demand coming through as well. So it's interesting times in the property space, and that's why you need to do your research and be a borderless investor. Don't just look in these bigger markets thinking that they're the only places where you're going to see price growth, because at the end of the day, there is the right time to get into the market, and there's also the wrong time to get into the market. So just understand that. Take this message to just be careful about what's going on. Speak to your professional advisors. Make sure you get some further information about this, because it's critical to your personal wealth creation story that you understand all of the risks and rewards associated with investing in bricks and mortar, because it's not a guarantee. Nothing is a guarantee when it comes to investing. So you need to be smarter and more informed. Thanks for watching.